Hi, Richard.
Hi, Dan.
Nice to see you.
Nice to see you again as well.
Nice outfit.
Thank you very much. You as well.
So we just wrote our quarterly letter, where the focus was on looking at what is currently being tolerated by the market to gauge the attractiveness of the investment landscape, or gauge the risk appetite of the market, which is the same thing. Before we go into the details of what is currently being tolerated, why is this idea of looking at what is being tolerated useful?
Well, it's useful. There are all sorts of ways to express how it's useful. One way is to, as always, quote Warren Buffett, be greedy when others are fearful and fearful when others are greedy. It's real clear that others, lots of people, believe, and I'm confident they're right, that AI will be a big deal. Something great will happen over a protracted period of time because of AI. And so they're willing to grab for the future at the expense of paying attention to the present to some degree. What that degree is hard to know. And this has always gone on. This is what capitalism does. People get excited about brand new productivity. Whether it was railroads in the 19th century, when, my gosh, if you were an investor, you had to own railroad bonds. And most of them went broke.
Right.
There are 4 periods in the past where this kind of thing, 3 periods in the past, 1 currently, where this kind of thing happened. In the 1920s, there was trucking. There was electric motors. There was the deflation that came from cars replacing horses, so that farmers had suddenly a lot more, what was pasture could grow crops, sell the crops, but the prices collapsed. So there was a whole deflation. Now, if you eat food, that's a good thing for you. And so the excitement of the new stuff, and in particular, you should think of radio. RCA sold at very high prices. Radio Corporation of America sold at very high prices. And we still have radio today. People were right to believe that radio was going to be a big deal.
Right.
After World War II, the productive capability that won the war in the United States, with battleship after battleship and plane after plane being produced in dramatic fashion, got turned into consumer products. And if you look at the post-war market, which ended with the Nifty 50, those were consumer companies. The consumer did really well buying the output of the factories that had been created and buying other things. And those stocks sold at enormous high prices, such that when finally inflation began to take off, we had a very bad bear market in the early 70s. The 90s, the internet was going to be a wonderful thing. And it was a wonderful thing.
Right.
Even though they probably built, during this boom and fear of missing out and excitement, way more internet than we needed at the time. We now use it all up, and it continues to grow it as a business. But the mantra was, you got to own Intel, they make the chips. You got to own Dell, or somebody like Dell, because they make the PCs. You got to own Cisco, they tie the PCs together.
Right.
Cisco's only recently passed its all-time high price. Dell went private when the stock collapsed, and Intel has had real trouble. So, but they left a system that's really terrific. The system now from AI will be really terrific. But some of the prices and some of the enthusiasm may be a little overdone. And certainly it's not a time to be fearful, as Buffett suggested. It's a time, it's a time to be fearful. It's not a time to be greedy.
Right.
Greedy is only good at great prices.
Right.
So.
Speaking of railroads, I remember in our old office, you used to have the railroad bond, the unclipped coupons
Yeah.
of a railroad bond framed.
That was,
Tell us about that.
That was a refinancing of the Memphis and Little Rock Railroad, which got off the ground, went broke, and the bond that I have has all the coupons. It was the junk bond of the time. It had a 7.5% coupon at the top, and I should explain. The way you got paid then in bonds is you clipped the coupon and went to the bank and you handed them the coupon and they handed you cash.
Right.
So the coupons for the Memphis and Little Rock refinancing never got paid, partly because the Memphis and Little Rock built their line on sand, literally on sand, on a sand bank overlooking the Mississippi River, and the first big rainstorm washed it into the water. But nobody paid attention to that kind of thing.
Yeah.
It was going to be great. Railroads were going to be terrific. Railroads are terrific. They bind the country together economically. But now we only have 4 or 5 of them in the country as opposed to scads.
Yeah, I mean, as you said, this is what capitalism does. And if we look at past cycles, any cycles really, you start out, at the bottom, standards are probably too tough, too high, because whatever industry that just went through a down cycle is now too fearful.
Yeah.
They're too fearful to lend, they're too fearful to build, whatever it may be. So, the market at that point is very intolerant of any kind of risk, probably to a point where it's irrational. It's, too much.
Well, it's the story of the cat who sat on the hot stove.
Right.
And got scorched, and then never sat on a cold stove again.
Right. But then what ends up happening is, eventually, as they realize that the world actually isn't as bad as once thought, standards start to ease.
Yeah.
Probably to a point of kind of appropriate. It gets to an appropriate level from extremely low or extremely high standards to appropriate. But then what starts to then happen is standards start to come down and down and down. And we see, this is kind of described in the bond markets as, being cov light.
Yes.
Right? Covenants, basically protective measures, protective covenants, protective rights. You start to see investors tolerating terms that are less and less favorable to them and more favorable to the borrowers.
Exactly. People get the crash in 1929 was a traumatic event for lots of people. It was a traumatic event for my mother-in-law, who's still alive at 98. She never owned a stock, but she's certainly afraid of what could happen economically in the country because of her upbringing. It wasn't until 1958, I think, that the market surpassed what it had been. So we had 10 or 12 years of bull market post-World War II before people began to look at, gee, what can this company do by growing rather than what's the dividend yield and how well is it covered? That, over the next 10 or 12 years, resulted in the Nifty 50 and all those wonderful consumer stocks selling at very high prices, and then that crashed.
Yeah.
So each crash is built on some other crashes. Each bull market is built on some other crash's foundation or rubble, and it takes a while for people to get their confidence back.
Yeah. I mean, and with the benefit of hindsight, we could see, just in the last 30 years, you touched on the dot-com period as well, but you start to see, for example, during dot-com, alternative metrics replaced traditional success and profitability metrics like the revenue and profits.
Yeah.
And markets at some point start to accept those phantom metrics, which turned out to be just that, phantom. Right. And also in, leading up to the 2007, 2007 and 2008 period, lenders were so eager to lend eventually that you were able to borrow money even without verifying, proving that you had a job or even the income that you were stating on the applications. And so standards became lower and lower and lower and lower until something went wrong.
I was just going to say, everybody every investor should read Michael Lewis's book, The Big Short, and should see the movie. The movie is really dramatic and funny. The Big Short, the book, is not so funny.
Yeah.
People got to ridiculous levels of trust in the system. Housing never goes down. Lending to people for their houses never loses.
Right.
We should always distrust anybody who says X never happens.
Right.
Or Y always happens.
Yeah, and just more recently, in 2021 period, we were hearing of venture capital funds using speed as a strategy. Putting term sheets on the table to invest in a money losing startup. Putting term sheets on the table in 48 hours, for example. Yeah. Now, they might say that they've done enough due diligence, but let's face it, in 48 hours, how much due diligence on a private company can you really do? But those things were happening because, speed meant that you weren't going to fall behind. Speed meant that you were not going to miss out on that next unicorn. So when you have things happening like that, those are, again, in hindsight, with the benefit of hindsight, those things are usually sort of signaling where we are in the cycle.
They're the kind of thing that should make you cautious.
Right.
They're the kind of thing that should provoke fear. When there is a substantial fear of missing out, something's being overpriced.
Right.
It's hard. There's a marvelous story in Out of Africa by Isak Dinesen. She's out on safari, and she has a couple of dogs. And there's a guy whose job is to take care of the dogs, hold the leash, even in the middle of the plains. A bunch of wild dogs comes by. Her dogs wanted like crazy to join the wild dogs because they were off to somewhere exciting from a dog's point of view. But fortunately, the guy had good, strong hands on the leash. The dogs didn't get away to what would certainly, because they were outsiders for the pack of dogs, they'd have been outside. They'd have been eaten up.
Right.
But the fear of missing something can happen whether it's dogs or people with money.
So in the letter, we talk about, we highlight three areas that are currently being tolerated by the market. First, the level of concentration. Second, the level of spending. And third, the level of returns currently expected from some of these investments. And, just to be clear, going out further on the risk curve, in and of itself, we can't say that that in and of itself is a bad thing. You could go further out on the risk curve as long as you're being paid enough.
Yes.
But going further out on the risk curve while not being paid enough, i.e., that's how we're defining how tolerance, that you're being asked to take more risk without being offered a chance of a higher return, is what we mean by
Well, this
tolerance?
type of there are two types of risk involved in any bull market that is based on a change in technology, the way the four that I mentioned, whether it's cars and radio in the 1920s, consumer products post-World War II, the internet, and now. There's something going on, and eventually things will be pretty good, quite good, maybe as terrific as everybody says. One of the things that is part of the risk is, will it happen, won't it happen? And you can be pretty, if you get real confident that it's going to happen, you might pay any price. Well, any price is a very bad price.
Mm-hmm.
Any price for a commodity or a business or whatnot is a really bad price.
Right.
And sometimes they never get back to that. Sometimes it takes a very long time to get back. And sometimes the business risk itself was so great that they just don't survive.
Right. Right.
And those are the risks that you have to gauge. But only one of them is fundamental. The others have to do with the price you pay, which is where the Buffett quote works. Greedy when others are fearful, fearful when others are greedy.
So on the point about concentration, so there are three different areas. When it comes to concentration, so right now, I mean, everyone by now have heard how concentrated the S&P 500 is. But actually, the concentration that we highlight that the market is currently tolerating goes beyond that. But on the S&P 500, right now, there's a basket of JP Morgan Asset Management has a AI basket of 41 stocks. And it's not just the NVIDIAs, the hyperscalers and the Palantirs of the world. It also includes, it has those, but it also includes some heavy equipment players, machinery, equipment companies that are supplying into the data center build-out boom, and also includes some utilities that are set to benefit because of the rise in demand for electricity. So this 41 stock basket currently was something like 45% of the S&P 500. So if we round it up, basically about half, almost half of the S&P 500 is in these 41, are basically in this kind of AI basket, if you will. So that's one concentration that we highlighted, but also just in the economy in general and in terms of CapEx and the amount of money that is expected to be spent. Right now, the 5 hyperscalers, so Amazon AWS, Microsoft, Alphabet, Google, Meta, and Oracle, combined, those 5 companies combined are expected to spend something close to $500 billion in CapEx next year. $500 billion is roughly how much the U.S. economy is expected to grow next year. Now, the $500 billion or so that the hyperscalers are going to spend, that's not all incremental, right?
They were going to spend money anyway.
So they're already spending this year something close to, or just under $400 billion is the estimate. So not all of that 500 is incremental, but a good 100 billion of that is expected to be incremental, which would be a very sizable chunk of the growth expected for the entire economy. So that's another area of concentration just in the economy.
Just one thing on that. People always take comfort in the phrase, it's different this time. Now, of course, it's always different this time.
Sure.
This is not the internet boom. That was the last one. This is not the growth of consumer spending from the industrial base of World War II. This is its own deal. And one of the things people will point to is, look, those companies that are going to spend all that money are really well capitalized. They've got great margins. They dominate their businesses. They have high cash flows. So what can go wrong when those are the ones doing the spending? Well, we don't know what can go wrong when those are the ones doing the spending. But if you pay a very high price for their success, you have something else to worry about.
Right, which we will actually come back to. But just kind of going back to the areas of concentration, the third piece, this concentration of CapEx and what that means potentially for the economy and for the market. So 4 of the 5 hyperscalers that I mentioned, the 4 largest, so that would be Amazon AWS, Microsoft, Alphabet, and Meta. Currently, the current expectation into 2030,
Right.
so not today, but in 2030, their combined CapEx is expected to reach close to 30% of all the combined CapEx of the large cap, U.S. large cap companies, which is about basically 750 largest companies by market cap. We have seen that's currently what's being priced into analyst models. And analysts have overwhelmingly buy ratings on these stocks. So what they're doing is they're modeling these kind of CapEx numbers in, and they're saying, and therefore, buy.
Yes.
Well, if we understand a little what that 30% concentration means, actually, this isn't the first time that we've seen that kind of number. For example, in the 1960s, concentration of the combined CapEx of the 4 largest CapEx spenders reached about 30% of the large cap universe as well. The difference is, back then, the 30% came from about the 4 big spenders came from 4 different industries. So it was oil, it was consumer products, it was textiles, and it was also, and the 4th one was food. It was Superior Oil, Procter & Gamble, Burlington Mills, and Anderson Clayton. So yes, there was concentration of CapEx back then too. However, it was spread among 4 different industries. This time, the 4 biggest spenders, which is who are expected to reach about 30% of CapEx, are all essentially spending on the same thing. So if you account for that, this is expected to be the most concentrated CapEx cycle in at least the past 70 years, and that is supposed to be really attractive. Now, that just to again to be clear, concentration alone, fine. Like it can be, they can have this concentration of CapEx, but when there is this kind of concentration, investors should be more demanding in terms of, well, I need to be paid more because when there's this much concentration, I need to be compensated for the risk
more risk
that I'm taking.
Pay me more.
Right? In any ordinary business, when we analyze companies, when we're analyzing a company that has customer concentration, for example, that 40% of this company's revenues come from one customer or one very narrow industry, we normally say, okay, we're going to assign a low PE for that business because there's a lot of risk coming from that concentration. Right now, when you look at the S&P 500, given this concentration of number of companies that are directly involved in AI, and the level of concentration that's going into one area, you would think that, okay, fine, if that's the future, fine.
The price would
but I'm gonna have to pay a lower price for that. So you would think that the S&P, PE multiple, for example, would be lower. Well, in fact, it's higher than average to a point where it's essentially the highest level on a trailing basis in the last 30 years. So that is something, when we look at that, we're saying there's a high level of concentration. Fine. But what is the market? Therefore, what's the price? What's the rate of potential gains that the market is demanding? And that number is actually pretty low.
Mm-hmm.
And that's not a good combination, or that's a concerning combination, is what we're saying.
Companies, companies, even well-financed companies, can spend too much.
Right.
And they end up providing the economy with some really cheap capacity on which they're not earning much. And that's what the price adjustment finally gets involved with. I'm real confident that the plants, the hyperscalers' facilities, will find use sometime. I don't have a good prediction as to when that sometime is.
Mm-hmm.
And I don't think anybody else does either. There are guesses, and some are well-informed guesses, and some are not so well-informed guesses. But the price makes that riskier.
Right.
Maybe it'll work. It probably will work in a fundamental way. Maybe it'll work in a securities markets way.
Yeah.
But there's less assurance of that than there is that it will fundamentally work.
Touching on the other two areas of risk that the market is currently being very tolerant about is the level of spending. So we know from having been in the markets and studied companies and CapEx cycles that usually when companies enter a big CapEx cycle, the market generally does not like that. Entering a CapEx cycle is fine, but doing so comes with risk because unlike operating expenses, where you're paying as expenses are incurred, the services are rendered.
You're generating the revenues now.
Right. CapEx, you're building now with the expectation that it'll pay off in the future, which, call it expectation, call it hopes, but you're spending the money now. Therefore, it's inherently risky, putting money in the ground, which is why, and there are academic studies, not just,
Right.
if you don't want to depend on our experience, you could look at lots of other studies that basically prove this point. Usually, when companies enter a big CapEx cycle, which means big unknown and the potential to lose money, investors then become more demanding in terms of being paid more, and therefore stock price goes down, so that the investors who are buying the stock has the potential to make more returns for the risk being assumed.
Yep.
Currently, we're in an environment where if you're announcing a big CapEx plan, as long as if it's tied to AI, not only is that being tolerated, but it's actually being rewarded.
It's being applauded.
Right. So, we could point to a number of different examples in the market, but basically, for example.
Well, you just included in the 5 of them, you just included Oracle. If we'd been having this conversation 6 months ago, nobody would have included Oracle in one of the big spenders. But when they announced that they were going to be joining this group and spending a lot of money, the stock went up, I think.
More than 30%, actually.
Yeah.
And when it comes to individual situations, there are obviously nuances. But when you look at it as a whole, the companies that are basically announcing really mega CapEx plans, as I've said, not only is that being tolerated, it's actually being rewarded with stock price going up because now the company's going to spend more money, because right now spending money is supposed to mean that they're not going to fall behind, that
or they're going to be part of capturing this marvelous opportunity.
Right.
Look, Larry Ellison is one of the richest people in the world, and he got there on his own efforts. He didn't inherit it. He created a business that grew, and he financed it properly. And he's made this decision. It's not to say that the decision will fail.
Yeah.
It's simply other people are now perhaps over-rewarding that decision so that the expectations can't be met in anything like a near-term or intermediate term basis.
Right. I mean, as an investor, a company saying that they're going to go out and spend a lot of money, that in and of itself is not positive or negative, as long as, okay, fine. Like if your plan is to go out and spend a lot of money, fine, do it if you think that's the right thing to do. I just need to be paid
Just pay me
for the
more.
risk that
Yep.
I'm about to take on.
Yep.
But right now, that's not what
That's
we
not-
are observing. When it comes to AI CapEx, and to be clear, that's not happening to all CapEx, because we know from our experience and currently in the portfolio, there are some companies that are still being punished for planning to spend a lot of money
to increase their
on
capacity.
on CapEx. But when it comes to AI, it's being rewarded right now.
Well, that's part of the standard procedure for improvement in the technology and the fundamentals of the economy. Capitalism stimulates excitement. Excitement makes people take risk. Some risk gets rewarded, good things happen, and the economy moves along.
Right.
It's a very nice thing, but it doesn't happen to everybody that they're successful. Not every new idea is a great idea. And from an investor's standpoint, you really want to be paid, at least in some intermediate term you can see, for the risks you're taking
Right.
with yours or your client's money.
And lastly, the third point, or the third area that we highlighted, was market and investors being tolerant of low returns. Right. So as I mentioned, the big four, the four biggest spenders, as you know, to kind of use them as a proxy,
Right.
they're expected to be about 30% of all the CapEx spent by large cap companies by 2030. So basically for the next 5 years.
Yep.
Over the next 5 years, their share of CapEx is supposed to grow very rapidly. Their share of revenues and free cash flow, though, is not expected to. It's still expected to grow, but nowhere to the level of CapEx being spent. In other words, the analysts are currently modeling, and these are published. You know, we access them through Bloomberg and the likes. They're modeling in a 5-year of CapEx growing faster than revenues and profits. And the conclusion from those models overwhelmingly is, and therefore buy. And the price target is, you know, some double-digit percentage higher over the next 12 months than where it is today. Whereas if you had told me, you know, we're looking at a company over the next 5 years, CapEx is going to way outpace revenue and profit growth. What should we do with this stock? You know, we would normally say, okay, well, we'd have to pay a lower price to compensate for that risk. But right now, the analysts are modeling in a future where you're really not gonna see a harvest period, at least for the next 5 years, and that is not only okay, but it's therefore buy.
It's a great idea.
So, you know, that's what we mean by investors are being tolerant of expected low returns. And you could also see that more generally, broadly. You know, we already talked about, I already mentioned S&P PE being at records on a trailing basis. But also, if you look at high yield spreads, the tightness of high yield spreads, basically what the riskiest corporate borrowers pay above the government risk-free rate to borrow money, is, you know, currently at under 3%, one of the tightest levels observed in the last 30 years.
You're getting paid very little to own poorer quality bonds.
Right. But that's okay, is basically what we are observing when it comes to trying to see what the market is tolerating currently. And so when we put all of that together and see that the market is being very tolerant of these things that are happening, that tells us that, risk appetite is high, which means that the attractiveness of the investment environment isn't that great.
Even though what they're going to spend the money on is likely to be successful, it's out there,
Right.
not here, and we're not being paid for it.
So one of the most common pushback that I get when I present this case is, somebody might hear this and say, yeah, you're right. I mean, those are just observations, right? These are our opinions. It's just observations. But yeah, that's correct. That's what's happening right now. But in order for this to turn into a really a bad bear market or a disaster, there needs to be leverage. There needs to be some debt involved, meaning like in 2007, 2008, when home prices began to fall, that was so damaging because the system had so much debt.
Debt, exactly.
And you talk about the 1929. We know that there was a lot of leverage, being used to buy stocks in the stock market.
Yeah.
But I know that you think debt is not necessarily a necessary ingredient for this to potentially be very damaging. So why is that?
Well, we have a much more developed options market, and options are not one-to-one. They're a form of borrowing too, some of them. And so you're putting down a little bit of money for a big change. That's leverage. And if it goes against you, you'll want your money back, but it'll be hard to get back. Selling quickly is fine for professionals and those who are paying attention to this every minute. For an individual investor, it's a lot harder, particularly those with a day job. Competing in that sort of arena. There's also newer forms of leverage. There's private credit. Credit used to be the purview of the banks. The banks were regulated. There were people looking at what they were lending and who they were lending to, and they were demanding collateral and so on. It's much less true today. And so if you buy into a private credit fund, you don't get the same kind of information. And if you don't get the same kind of information that traditionally was available, traditionally was required by regulation, not everybody's going to give you what you should have. They'll give you what they can get away with giving you. And if they can get away with giving you less information, maybe the information isn't that good quality. And so you don't really need a lot to go wrong when that kind of thing is happening.
Right. I mean, one thing that we point out is, so first of all, on your point about leverage in stock purchases and in brokerage accounts, it was recently pointed out, Paul Tudor Jones pointed out that even though margin debt levels relative to the total market cap right now appear to be lower than where they were leading up to the dot-com crash.
Right.
If you actually include leverage ETFs, which were not available back then, and that is a new form of investors accessing leverage without actually borrowing from their brokers. If you actually add that, the number actually goes up to above 2%, which then kind of rivals
what it was.
not the very end of the dot-com level, but certainly kind of 1999 type levels. So that is one thing. But another thing that we highlight is the fact that stock ownership is more prevalent and widespread than ever. There are studies and surveys that indicate that something like 62% of U.S. adults
have
own
some
stocks.
interest.
And if you actually zero in on those that make 100K or more, that number, the participation rate number, goes up to 87%. So pretty much everyone earning that much money has a meaningful or has a decent amount of or some stock exposure.
They're
I should
involved.
say. And when you actually pull them together as a group, other financial assets, so financial assets excluding your homes, actually is a bigger percentage. The value of that is a bigger percentage of a U.S. household balance sheet than the value of homes is. And then when you unpack what is owned in those other financial assets, according to Bridgewater Associates, about 80% of that is stocks. And it is mostly, not all of it, but mostly, or U.S. stocks is the single largest portion of that category of that. So, earlier we had mentioned that, how the S&P 500, half of S&P 500 is essentially, AI-related stocks. Just if, and I know it seems implausible that that AI could disappoint right now, because anything AI is basically going up and to the right. But just if some of this turns out to be, not as good as expected or disappoints, then the effect could actually be pretty widespread.
Yep.
And not everyone has to lose everything. Not everyone has to lose everything in order for such an event to start having ripple effects into the economy in terms of confidence and spending. So it's something that is worth paying attention to as a potential risk factor.
This is how the speed of a downturn is surprising. It's, well, I want my money back. Okay, I can't have it all back, but give me what I've got.
Right.
And it gets people excited in a different way from the animal spirit's excitement of good things are happening.
Right.
That's why it's called fear and greed.
Yep.
They're both emotions, and people act on them in an emotional way.
Perhaps enough with the worries and risks and all the things that could go wrong. What are the opportunities? What's the opportunity in all of this?
Well, I'm tempted to say the opportunities are where people aren't concentrating their risk appetite. And so things that have been ignored or haven't gone anywhere for a while, particularly if they are really well-run, well-capitalized companies with decent businesses, they just simply aren't in favor at the moment. They're simply not providing the kind of spur. So that's one category. Some of the investments in AI will actually work rather quite well.
Yep.
And perhaps those are the arms dealers to the people who are spending the capital, the people who are selling the equipment that becomes the capital spend, that is the capital spending. That might be a real place to look. And certainly the beneficiaries as they emerge, those companies that aren't involved in creating AI, but have figured out how to use it well, and are enhancing either their business reach and what they can do, or their margins or their profitability because they're using AI well. That requires an extra step or two of analysis, but it's likely to be very worthwhile.
Yeah, I mean, if your goal is to only go for the highest possible rate of return, and if you believe that that's going to come from AI, perhaps you have to invest or have to have most of your investments in AI, but it's also kind of helpful to be reminded that there's a lot more than just AI and compute in this world that people are still going to need, the world's still going to need that is going to generate revenue growth and profit growth, and therefore, price appreciation.
For AI to be successful, its customers will have to be successful. So find some customers that are going to be able to use AI well. One of the possibilities is all of the number crunching and work that can be done quickly through AI that leads to discoveries in pharmaceutical companies. That's a worthwhile thing to spend some time on.
Yeah, and I actually think, and we think that now is probably a good time to be keeping some powder dry. Just sort of the point where you may want to really go all in, even lever up if you can, take out your grocery money and say, I want to basically put every dollar I have into whatever that is probably the time when you should be doing the opposite and trying to keep some capacity available for better times and better opportunities, because there will come a time, or will is too strong a word, but it's highly likely that
in the past there always has been.
In the past there always has been opportunities to actually invest in these really exciting trends in AI on much better risk reward terms. And I'm reminded of the period following 2021, in 2022, when all the tech stocks and especially software stocks really crashed, following 2021, when basically if you were SaaS, you went up a lot. They all crashed, including the almighty Microsoft, which went from peak to trough down 35%, 37% or something like that. Once that happens, not only are you then able to pay lower prices for some of these businesses that are going to go on to do really well, usually at those times, you basically have the separation of the wheat from the chaff.
Yeah.
And you could actually pick higher quality with greater confidence and pay lower prices.
Yep.
So, that is an opportunity that is likely to present itself in some medium-term future.
One piece of advice along these lines is, don't find yourself in really crowded trades. Don't find yourself doing what everybody else is doing. If you do find yourself being crowded out by others, maybe let them go for a while and step back and wait till it's easier to make a decision.
Well, with that, thank you, Richard.
Thank you, Dan.
We'll see you next time.